As promised at the very beginning, in the last part of this video course I will say a few words about the performance of double-barrel gun trading strategy. Speaking about the performance of trading strategies in general, when assessing a particular trading strategy, the majority of traders operate with the following parameters. By the way, you can see them after building a detailed trading report in the MT4 platform. With regard to double-barrel gun trading strategy, it should be noted that this strategy was first tested on historical data in 2003. Here are the results of backtesting for the period from December 2002 to June 2003. Here is the equity curve chart of double-barrel gun trading strategy, which uses a conservative money management approach. The initial conditions for the strategy backtesting were as follows. The initial amount of trading capital was $1,000. The strategy had been tested on three currency pairs, Euro versus US dollar versus Japanese yen, and British pound versus US dollar. During the period of backtesting, the maximum profitability of operations had reached 142%. During the same time period, the maximum drawdown had reached 9%. The share of winning trades in the series was close to 65%. When using aggressive money management approach on the same sample of historical data, the maximum profitability of operations had reached 208%. The maximum equity drawdown during the backtesting period had reached 17%. After gathering all necessary statistical data on the effectiveness of the trading strategy, it is also possible to calculate the mathematical expectancy. What does this figure mean, and what kind of information does the trader get from it? In the book Trade Your Way to Financial Freedom by Van Tharp, the famous market guru and the author of many books about trading, explains that any approach used to make money in the markets must have a positive expectancy. Simply put, expectancy is the amount of money you expect to make per dollar that you put at risk over the long run. Here is how you should calculate the mathematical expectancy. You have to get a sample of at least 30, but preferably over 100 trades generated by your trading strategy, or your actual live or simulated trading, and then use the following formula. If after accounting for the cost of slippage and commissions, your expectancy is negative, then you will lose money in the long run and you should not trade with that approach. The larger the expectancy, the more money you expect to make for each dollar that you risk, and the more profitable your strategy or approach should be. Let us again turn to the game of roulette in order to properly clarify this point. For example, we will bet $1 on a single number. In the case our number is hit, we will win $35. The probability of such event is equal to 1/37 or 2.7%. In all other cases, with a probability of 36/37 or 97.3%, we will lose $1. So, in the case of placing our bets on a single number, the mathematical expectancy of the game of roulette will be equal to 0.027 or minus 2.7%. What exactly does this result mean? It means that if we play a sufficiently large number of rounds using the method described above, then our theoretical income will be approximately equal to minus 2.7% of the total amount invested in the money game. The minus sign in the result indicates that the game would be unprofitable for us in the long run, and provides a mathematically founded answer to the question why the casino has an advantage over a player, as well as lets you know the exact percentage of the advantage. Now back to the double-barrel gun strategy. For example, if a trader applies the conservative capital management approach to the strategy, the mathematical expectancy will be equal to 0.127. What does this value mean for the trader? This means that when a trader opens a trade using the signal generated by the double-barrel gun trading strategy, he can expect to make about 13% of the total amount invested in his trading, or about 13 cents for each dollar that he puts at risk over the long run. If we talk about performance indicators, then another important value, which needs to be calculated, is the standard deviation of the trading results, or in other words, the degree of stability of the results. The greater the standard deviation, the more volatile and less stable trading results will be in the future. Conversely, the lower the standard deviation, the less volatile and more stable will be the results. Other things being equal, you should always choose the strategy with a minimum standard deviation in terms of individual results. Here, I will not provide a mathematical formula to calculate the standard deviation, because it takes a lot of time and is not the purpose of this video presentation. The only thing that I would like to mention here in this regard is the fact that the stability of trading results produced by double-barrel gun trading strategy decreases every year in the period from early June to late September. I attribute such a behavior of the strategy to the drop of liquidity in the market, which is quite common in summer, and accordingly, do not recommend to use the strategy in this period of time. Quite often, traders have a strong desire to increase the reliability and improve the performance of the strategy they use. Unfortunately, it must be noted that the ideal strategy that fits all traders simply does not exist. Of course, the strategy can be improved indefinitely, but don't forget that any change to the strategy inevitably leads to decrease in the number of opportunities for its application in the market. Nevertheless, I there offer two options for those who want to experiment in this direction. The first option for solving this problem is to increase the percentage of winners in the series of trades. This can be done by increasing the likelihood of a positive outcome of a trade. But how can the trader increase the likelihood of a positive outcome of his trade? One of the options the trader can choose from is to use several different trading strategies simultaneously, and open the trade only after the signals generated by different strategies are duplicated. By the way, this approach represents only one of the many types of diversification, the ultimate goal of which, as you know, is smoothing the yield curve. Thus, it is quite possible that within a single time frame, as in the case with double-barrel gun strategy, the chances of a positive outcome of a trade may be slightly lower. However, if there are confirmation signals from the larger time frames generated by the long-term and the medium-term trading strategies, then the chances of the positive outcome of the trade may increase significantly. For exactly this purpose, I recommend to use two proprietary analytical tools: the technical profile of the financial instrument and the market sentiment indicator, that may help any trader to increase the likelihood of a positive outcome of a trade. What is the technical profile of the financial instrument, and how to read the power balance chart? Some information on this subject can be found on my official website, but in the framework of this video course, I will give a few explanations. For those who want to use the new market sentiment indicator in their trading, I can offer a subscription plan for the service in the following segments of the global financial market. To subscribe, please submit your request on my website. The second option for solving the problem is to improve the profit-loss ratio for the series of trades generated by the trading strategy. How can the trader ensure a more favorable profit-loss ratio of his trades? In the case of long-term and medium-term trading strategies, the problem can be easily solved. Here, the main criterion for selecting the trades should be the availability of the potential price targets that may provide a more favorable profit-loss ratio, such as 3 to 1 or even higher. On the other hand, market price may travel all its way to the designated target. Sometimes it may delay its start for a few hours or even days. And in the worst-case scenario, it may not reach the target at all. In the case of short-term trading strategy, it's quite another matter. Here, the bet is made on the fact that the financial instrument will behave itself as usual, that is, its price will have a certain range of fluctuations within a day, comparable to the average daily volatility. Moreover, the amplitude of price fluctuations does not have to be equal 100% of ADV. Instead, 2/3 or even half of this value will be enough for the trader to make profit using the rules of double-barrel gun strategy. I think you will not argue that the probability of such an event is very high. For your information, in the framework of trading a portfolio consisting of the 3 different trading strategies, the full version of double-barrel gun trading strategy offers a more favorable profit-loss ratio, where with the help of competent money management technique and position hedging algorithm, a ratio close to 1-to-1 is quite common scenario. At the end of this video course, I need to mention one important point. It's up to you to make a decision whether to use double-barrel gun trading strategy in the real market or not. However, I would like you to remember that all information contained in this video course is used for educational purposes only, and cannot be a guarantee of success. If you do decide to trade by the rules of the strategy, then, here is my advice to you. Before you start trading on a real account, please try to trade some time on a demo account first. Make sure that you properly understand and easily follow all the rules of the strategy. Only then, you will understand whether this trading strategy fits you or not. Now it's time to complete my video presentation. I want to thank you for your attention and wish you all best in trading. Hope to see you again very soon in my next series of video. Good luck.